Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for November 30th, 2020. Please see our disclaimer for important information. Well, the conversation this week, as we close out the month of November and enter into the last month of 2020, I know a lot of people are very much looking forward to getting out of this year and getting into next year. We're in a little bit of a transition period, I would say, and we'll talk about kind of the data. We'll talk about a little bit of the risk factors and some of the cross currents that are out there right now. But for the last week, we had a really good week, I should say. It was a short week because of the Thanksgiving Day holiday, and hopefully all of you had a wonderful Thanksgiving Day. For the week, the Dow was up about 2.2%, S&P was up 2.3%, the NASDAQ was up 3%. The Dow by itself was up 13% this month, and the S&P was up 11% this month. And the Russell 2000, which represents small caps, was up almost 20%. And when you look at the global market as a whole, it was probably one of the best months we've ever had. Global stock market was up about 13%. And so there's not a lot of fear in the market right now. Volatility, the VIX index was down almost 50% this week. Gold was off about 4.5%. I think that some of those unloved areas of the market, like energy, were up big last week. In fact, we've got really strong relative strength from a lot of the energy stocks out there now. And we've got a lot of indicators that we've talked about, and I showed a couple of these in our charts of the week pack. But our put call ratio, which is extremely low right now, and that's exceptionally bullish. I mean, we haven't seen this level of bullishness in a long time. And the difference in stock and bond returns, the number of stocks hitting their 52-week highs, the ratio of those stocks versus the ones that are hitting new lows is extremely outsized from its historical trend lines. And the moving averages are really positive as well. And so there's a lot of, I call it exuberance in the market. And obviously with Janet Yellen being President-elect Biden's pick for Treasury Secretary, the markets are extremely happy at that. I think worried about, if it had been somebody else like an Elizabeth Warren, say, where there would have been increased regulation, a lot of burdens for the financial industry. I would say that was as about a positive a pick as you could have, because we know that she's going to work well with the Fed, having been there, and it kind of gives the sense that Biden is thinking about the investment markets. There won't be any confirmation issues with her, and she's got a lot of experience in dealing with crises, and she brings a lot of institutional knowledge, and also I think, and very importantly, that she has said consistently that she stands by the theory of needing to provide extraordinary support in times like these, in times of stress, if you will. But so let's kind of talk about what the tailwinds are. I mean, we're past the election now. We have increased vaccine news out there that's getting people excited, including some doses that can be delivered here in December. And a lot of money is flowing into stock funds. In fact, we had almost 50 billion that flew into stock funds last week versus just over 30 billion the prior week. And and we've had third quarter earnings, which are now in the rear view mirror, and we had a fairly stout beat of estimates going into the earnings season. So investors are highly bullish. They're looking past the prospects of near-term economic weakness. Manufacturing data are holding up, and there seems to be a lot of good things going on. Investor sentiment continues to climb on increasing evidence that we'll have a vaccine that will be, more broadly distributed during the first half of next year. But not to throw cold water on the party here, but I think investors are looking past some risks in the economy, and so the number of Americans hospitalized with COVID is above 90,000. Importantly, we've seen jobless claims jump for the second week in a row, and not a trend that you want to see necessarily. And that's actually the first time since July that we've had claims rise 2 weeks in a row. We also see some signals on the margin that consumer confidence may be slipping a little bit. And we know that global trade remains depressed. And there's just not a clear upward trajectory for the global economy right now. And so, when you really, what you really need to feel really good about the market is if you can visualize a kind of what they call a synchronized global economic expansion. We just don't have that right now. So, I think clearly we're going to need more fiscal policy support. There is some conversation of a compromise that Biden and we've got Mitch McConnell in the Senate, that they've worked together, they've known each other for decades, and can potentially compromise. So, we just don't know. We'll have to see what that looks like in the coming weeks. I think there's not a tremendous amount of optimism that we'll get it in December. We clearly need it, and I've got some small business statistics to kind of share with you in a couple minutes. But I'd say that stocks itself or themselves are kind of in an uncertain position here. It is possible that the rally could continue a little bit, but in investor sentiment and all of these indicators, has risen, and expectations are pretty high. The bar is set extremely high, which I think does make markets, at least in the near term, be a little bit vulnerable. So much is built into this market, and I would really not be enthusiastic about wanting to try to chase returns here. But but I think long term we're in a pretty decent position. But I think just over the near term, we're kind of vulnerable to kind of, a pick back up in volatility and perhaps consolidation within the market. Some other observations I see out there, manufacturing, I think we've talked about a little bit, really strong. We've got some charts in the chart pack this week that kind of show that. The purchasing managers index, the manufacturing index was a stronger than expected number. It was clearly in expansion mode, which is good. And I mentioned the weakening confidence, and we've got rising unemployment claims, as I mentioned. And again, I think there's negatives out there that, I think the sentiment indicators and some of these other indicators, I think just point to the market just simply being overbought, not overdone, not that the expansion or the market growth is done. I think we're just, we're close to a potential pause here. But, clearly you have to take stock of what's happened and what's transpired here lately. We've had the best and the broadest market rally since 2013. And I mentioned that before we were up 80%, over 80% of the S&P 500 was above its 200-day moving average. Well, that number is now 92%. So there's very broad-based support for this rally, but it just seems to have gotten ahead of itself just a little bit. When we talk about some of the risk factors, and I talk about small business all the time, and there's some data from the Washington Post that we're seeing increased stress in the homestead, and particularly on food and provisions and things like that. We've got a lot of these austerity programs that are going to expire at the end of the year. A lot of households are really kind of struggling. We've got We've got 6.4 million job openings and 20 million people that are in unemployment right now. And we know that unemployment insurance and coverage is set to go away. We know that at the end of next month that we've got a lot of forbearances and proclivities against evictions that are going to expire. And we're also seeing a lot of increased activity at food banks and things like that. In fact, this article in the Post indicated that 1 in 8 Americans reported that they sometimes or didn't have enough food to eat, and then 1 in 4 out-of-work Americans with children don't have enough food to eat. And the fact that food prices are up year over year is making it harder for them to feed their family. And the Post goes on to say that there's more hunger in the U.S. today than at any point since 1998. And then you've got the socioeconomic issues as well that are at bay too. So you go down into the minority components of our population, that particular problem gets even more acute. So and I just don't want to be agnostic or turn a blind eye to those types of things, because I think those are more systemic issues that are going to take a while to work themselves out. And I think it underscores the need, the urgent need that we have for more fiscal stimulus. Student loans, article in the Wall Street Journal talked about that. We know that there's a lot of stress on a lot of areas, but in education for sure is one. Community college enrollment is down, student loan losses. And just looking at this article, there's 1.3, almost 1.4 trillion that's owed in student loans. And I think the expectation now is that you're going to have $400 billion of losses, which is a huge sum, clearly more than what we've seen now. It doesn't include the $150 billion in loans originated by private lenders and then backed up by the government. And when you put this in perspective, private lenders lost about $530 billion on subprime mortgages during the entire 2008 financial crisis. So the numbers that are being bandied about here, just in the student loan market, are actually fairly staggering. And if you couple that with the fact that you've got lower attendance and you certainly have lower overall international attendance that may take a while to work itself out, that could put a lot of stress in the whole education sphere, which leads to other second-order impacts, in my opinion. But you've got a lot of folks that are they can't or just struggle to educate or educate remotely because of poor internet and things like that. But I just mentioned that in passing. I found that pretty interesting. And in the small business sector as well, I'm very cognizant of some of the risks there, and we continue to monitor the stress in the small business sector. So again, my attitude may sound a little bit more negative than it might be, but I do think that we're at risk of seeing some, a permanent destruction in the small business sector that's going to take us a little while to build out, maybe even on the order of a couple of years. That's not to say that we're not going to have a good market in those next 2 years, or that we're not going to have a very good economy in the next 2 years. It just prolongs the time at which it's going to take us to recover what has been lost this year. But we'll continue to monitor these developments. Continue to watch the tea leaves as the new administration begins to take shape and take form, as the Senate situation works itself out with the runoff at the beginning of January, what that does to the balance of power in Congress and how that translates into additional programs for stimulus. A little bit more encouraged, with having Janet Yellen at Treasury. I think she's, very market friendly, and obviously the market has enjoyed that announcement, to date. So I'd say, we're continuing to just be vigilant and monitor the coronavirus data. It is high, and I think there's a lot of speculation out there or outstanding with regard to what those case counts are going to look like 2 weeks forward after, some of the people that I guess that might have been gathering with family, or some of the, 50 million people that were traveling last week were, if they get sick. We just need to see what that data looks like, because that could have some adverse influence on market sentiment, et cetera, here in the month of December. We will conclude this week's program. I hope you've enjoyed this. Feel free to reach out at the information you see on your screen. We'd love to hear from you. And I hope you have a safe week, a wonderful week, and we'll talk to you again soon.